Welcome aboard the ACCT 2302 train with your conductor, Professor Naragon, bringing you now Chapter 23. Yes. Ah. And we're going to bring in the greatest and latest of basically decision making. And we're going to go over six scenarios. Just like the Infinity Stones, we are going to make them, and this is going to make the decisions for the business that the management does. And it's actually going to be interesting. We actually get to pick either or. So half of the decisions go away. Anyway, so starting off with Chapter 23, we're going to deal with the 5-step process to decision making. And really, it's what we've been doing already, and it's just in graphic form, because you know me, I love the graphics. So first step that we do is define the task and goal, what we want to achieve. From there, we're going to identify alternative actions, plan A, plan B, plan C, plan alpha, plan omega, plan expendables, whatever, plan cows and chickens. We're going to collect relevant information on these actions, and then we're going to select which course we'll deem right. Just like Thanos and wanted to kill half of the universe. He had two alternatives, and he gives his reasons in the movie. So after that, we analyze and assess the decision. Was it right? Are the Avengers coming for us? Kind of thing. So, with that, how we make decisions is basically based on 1, relevant benefits. What we have, which basically is additional or incremental benefits. We typically use the word incremental a lot in this chapter. So that just means what's going to get added on. Okay? And really, if we generate by selecting a certain course of action over another. So, is it good? Is it bad? Will it give us more money? Will it not give us more money? And we're going to have to figure that out. And then there's also relevant costs. And these are additional costs that incur if a customer pursues that course of action. So again, incremental cost that can happen for this action. So we can further break down into 3 types of costs that we've kind of heard about. One is known as sunk cost. And these costs come from the past, they're in the past, and cannot be avoided or changed. They're irrelevant to our future decisions, meaning they have no consequences to what we're about to do because it's already happened. It's in the past. So, Hakuna Matata. So basically, treat it like sunken treasure. That's how I've always done it. I mean, it's in the sea, it's lost, it's sunk. And basically that's what's going on. The book wants to use cost of computer equipment already purchased by the company that's used in a future action. So we've already paid for the equipment. We're now going to see if we sell it or maybe keep it, but the cost is already there. I like to also look at if you're a sports person. When you look at like the NFL, they talk a lot about cap hits. It's like, this is going to cost us this much if we release this player. This is going to cost us this much if we don't. A lot of times those cap hits are basically a sunk cost. They cannot be avoided or changed. It is what it is. You're going to lose money on this player if you let him go. You're going to lose money if you keep him. So they're going to look at the sunk cost of contracts to see what is going to be the best benefit. Next, you have out-of-pocket costs. And these out-of-pocket costs, let me zoom in so you can see like the whole page. The out-of-pocket costs in themselves are future outlays of cash that's going to be to a future decision. Their example again is computer equipment that's purchased to perform current and future actions. If you want to relate to this one, best relate is anything with insurance. They have out-of-pocket costs labeled right there, and that's your deductible that you have to pay first. That's your out-of-pocket cost. Well, that's what really is going on. That's our cost for something that we're about to do, something in the future. So that's another way of thinking about this. We will get into all these costs as we go through the scenarios. So the last cost that we're going to define is opportunity cost. And this happens to be the potential benefit that is lost by taking a particular course of action and not choosing one or more other alternatives. This is really kind of like our timeline change. Well, if I did this, how much would I've actually made? Compare if I did this, if something's taken over for something else, how much am I losing? So book uses resources used for one action instead of being used in another action, or how much benefit was lost by choosing the chosen action instead of the rejected action. So when they say opportunity knocks at the door, this is kind of how a business goes. They're going to look at this. It's knocking. Should I answer and take it? Or is it the IRS about to tax me some more? That's stuff that the management's going to look at. We're going to help management figure out what the best decision is. But in the end, it's usually theirs. So you're going to see that with every scenario. We're going to take the scenario. We're going to look at it as accounting. And then we're going to have a few little management quips that they like to see. Whoa, magic. Magic. So, let's jump in. Scenario number 1. And this scenario is using additional business. So, every now and then. Yes, I am the most interesting professor in the world. He's done everything. Yeah, no. This is all about additional business. Yeah, additional. So, we're already making our product, and usually our factory is humming along. It's doing good. And every now and then we'll get one of those clients that say, hey, if I pay you this much and buy this product, can you do it? Or will you do it? So, normally we're not at full capacity because we don't make profit that way. But sometimes, we're going to see. So we're going to take Fast Track. And Fast Track is a company that makes all sorts of things. And we're going to say that right now they're in the exercise equipment. Because, yeah, they want to pump you up. It's not. But, sorry. So Fast Track, they're currently operating at 80% of its full capacity. And while doing that, they're producing 100,000 units of product each year. So, we have our contribution margin statement. I'm going to zoom out so you can see the whole thing. And this shows us at this capacity of 100,000 units. They're selling them for $10 each to make $1 million bucks. And they have their variable cost. They have their fixed cost. And they have whatever operating income. So really, on a per unit base, they make $1 of profit. Yeah, it doesn't seem a lot, but hey, it's profit. So, the scenario goes is this. A current buyer of Fast Track products wants to buy an additional 10,000 units, but they're only willing to pay $8.50 per unit. So when we add additional product, we may have some changes going on depending on how it goes. So these changes under this condition follows as this. Variable manufacturing costs, our big three, would remain the same. Again, usually variable cost on a per unit basis is basically the same price, but again, since we're looking at this under budget or estimate, they could change according to the scenario. Selling expense would drop from $1.40 per unit to 20 cents per unit. Nice. Fixed overhead will remain the same regardless of decision, thus the information is irrelevant. It doesn't matter how much we make on fixed overhead, it's still the cost has happened and it still will go. So this is why it's irrelevant in this situation, because basically it's already done. The 100,000 units basically paid the fixed overhead already. So we don't have to worry too much about that part. But administrative cost would increase by 1,000 for this additional order, which would be about 10 cents per unit added to the 80 cents. And in order to get that 10 cents, you just take the 1,000 divided by the additional units of 10,000, and that gives us 10 cents. So the question management will have with this, let me again zoom in, is should we accept this order or reject it? Right now, if we just eyeball it, most people just hone in on the sale, which is $8.50 for 10,000 units, which is less than $10 of that we're selling. And most people go, well, since the sale is less, I'm going to reject. I'm not going to make money. But you have to put in all the other scenarios, other changes that happen on making this 10,000 units, producing this. So let's find out how we can solve this scenario. So there are quite a few ways to break up a problem like this. We're going to look at simply the easiest method. So easy peasy lemon squeezy. And this is going to be basically on per unit total dollar amount basis, using only the information that's relevant to the additional production. So let's start out. Okay, so we create our contribution margin income statement. Again, this is just for the special order. It's selling 10,000 units, so $8.50 times 10,000 gives us 85,000. The scenario did say the big three did not change, so direct materials, direct labor, and variable overhead all stay the same. We multiplied those by 10,000 units, but selling expense dropped down to 20 cents to create the 10,000 units. So now that's at 2,000. Fixed overhead, nothing irrelevant to us, so it's not even a part of this equation. And administrative expense is only an additional 10 cents. Be careful, because the scenario put it 80 cents, is like 10 cents additional to 80 cents. If we look up here, see 10 cents per unit added to the 80. Do not do that, okay? It's only what will be increasing. So it only increased by 10 cents. So we take our 10 cents, we're going to do our contribution margin, which was $2.10 after we take $8.50 minus all the variable cost, and then just take administrative expense from that. Equals out to $2 in operating income per unit. Well, $2 times 10,000 is 20,000. We would actually make 20,000 in income. Woo woo! Show me the money. So when you break it down like this, it actually tells you that yeah, it's a good deal. It's a good one. So, few notes. Again, this is me just explaining again. So keeping the big three, even though they remain the same, we keep them because they're relevant to this cost, because it's a variable. And fixed cost is irrelevant, so it's not doing anything. And the other items have changed, and we only include the amount relevant to this order, or basically what's adding on. So again, based on this, we should accept it because it made us money. It still makes us money, but there's other factors to consider. Like I said, that's the accounting side. Management has to think of other things too. So they're going to think of, well, if we do this product in volume, will it require an expansion of production capacity? Additional cost could be incurred to that. So we could have to expand the factory. If so, we have to put that into the analysis also. If additional product amounts have a negative impact on current existing sales, then we would have opportunity costs factor in. Again, we're not going to go heavily depth. This is something you probably go into cost accounting or even intermediate accounting if you're an account major. If customers is going to be a long-term customer, then that lower sales price though will be not sustainable in the long run. So you have to, as management, we'll have to see how this customer is, and then we're going to have to ask, if you're going to be long term, this was a special like one-time thing or workout contract that you can only do it so much, and that may end up causing them to leave. But then again, you've already made a profit already on your stuff, so management's going to judge on that. They will judge. Everybody judges. So scenario number 2, we're going to take now. Should we make it or buy it? Sounds like a game show. Make it or buy it. Do 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 do. So again, Fast Track is around, and they are making part 417 is a component that they sell. They purchase it from another company, and they pay about $1.20. Okay, so they pay $1.20. However, Fast Track is now considered producing part 417 on its own and no longer purchasing from another vendor. Oh no, they're gonna purchase it. They're gonna make it, Reggie. They're gonna make it. Well, we put in how much would it cost us to make it. So our analysis says to cost would be direct materials per unit of 45 cents, direct labor per unit of 50 cents, and incremental overhead, again, is going to be 20%. It's the added overhead, okay? We do not use predetermined overhead rate because that's over the whole thing, okay? Then all we're doing is focusing on what's being added on. Again, so questions going to land. Should part 417 be purchased or manufactured? Well, let's see. The best way to do this is just a simple comparison. Okay? So, we know the cost to make it. It's going to be 45 cents plus 50 cents plus 20 cents of the big three to make a cost of $1.15. And we buy it at $1.20. Well, it's cheaper for us to make it, so thus we would probably make it than continue to buy it from another vendor. That's really all we do is compare what the two options are. Buy it or make it. What's my cost? Well, again, management has other things to deal with. One, they're going to ask, is our quality better than what has been purchased? If it has, then yeah, go with it. If it's not, it may actually be bad. And for a nickel, why would we really hurt ourselves that way? You also have the customer and supplier reactions. Customers may actually see this and be going, oh no, they can't do it just like that. It's scary. I don't like it. I'm not going to buy from them anymore. Ooh, I'm going to bomb this game because it doesn't have what I want. Oh. Well, that's customer. Customer is going to make their decisions. Suppliers on the same side. You may have a supplier, you may only get a few parts from, and this is one of them. Well, if you decide to make it, you may strain that relationship with the supplier, where they may stop producing or selling you the other parts. They may be talking to other suppliers. Oh man, they are making the parts now. Why should we buy? Why should we sell, or why should we do this? They're trying to cut us out. Man, I hate them. Blah, blah, blah. So, management's going to think of those. They're going to really see, is really a nickel worth it per unit? Sometimes it's best just to keep the relationship. Sometimes you didn't like the supplier, so might as well make it. It's whatever. So, they're going to look at more factors to it. Again, all we do is tell them, this is what it is. If you buy it, this is how much it costs. If you make it, this is how much it costs. And by this analysis, it shows it's cheaper to produce. Okay? So, scenario 3. Yeah, halfway through, hitting number 3, and this is scrap or rework. So, in this factor, we have defective units. And should we actually rework them and repair them, or scrap them and discard them? Okay, so this is cost incurred in production of the defective unit are already incurred, so thus they're irrelevant. So costs have already done for the defective unit part. We're now going to see what the additional to fix that defective. Reworking units take up production capacity. So they're going to take up those capacity and potential additional resources that could be used for production of normal units. Thus, it is considered an opportunity cost, because we're basically inserting a unit that's already been made and basically fixing it. So we're causing something that hasn't been made to not hit the line yet. Okay. I like to think of this, if you like the real world, GameStop, if you ever gone to trade a game or a system to GameStop, they're going to look at it and they're going to ask, basically make sure if it's defective or if it's able to be used, sold. If it's defective, it goes to a warehouse where they make this decision. Should we fix this part or fix it, or are we going to scrap it and discard it and use it as parts, basically? So that's their decision. Usually they get the stuff cheap anyway, so it's an easy decision for them. Yeah, but Fast Track somehow determines that they have 10,000 defective units of product. It's already cost them $1 per unit. They don't make, they make really cheap stuff, huh? But this is just the scenarios. They could have some other division that actually makes good gym equipment or something. But these units can be either sold as scrap for 40 cents, or they can be reworked for 80 cents per unit and then sold for $1.50. So the question should be, should we scrap it or rework it? So they're making more money if we decide to rework it than scrapping. So some people, again, using the eyeball test, would be going, that sounds good. Let's go with that. But this is our analysis going on. So with us, the sell, we compare the sells. Yes, scrap gets 40 cents, rework gets $1.50. Reworking's being out on that. But because it's being reworked, it's got more cost. One is out of pocket, which is that extra cost to rework the defects. So additional cost of 80 cents. Now we got opportunity cost. This opportunity cost is 50 cents. And we'll get into why it's 50 cents in just a sec. So the incremental net income per unit compared to, once we subtract out of pocket and opportunity, is 20 cents. So now scrap looks better. And we're going to scrap them then. So how did we figure out opportunity cost? Alright. So the 10,000 units, if reworked, takes away resources from producing new units. Okay? So when we factor it in, the 10,000 new units would cost us $1 each to produce. Sweet. Remember, it takes us $1 to actually produce 10,000 of those defective units. They're only going to sell for $1.50. Thus, the company is actually losing 50 cents on each one. There's $1.50 minus $1, so take your sell of each unit minus the cost that it would take to produce, and that could be made, and this will be the opportunity cost. Because of the difference right there, we lose out a potential of 50 cents basically to make if we just made new units. Okay, so we do have a little opportunity cost, and basically this is the most thing that gets missed when we look at scrap and rework, because this is really the only one that we're going to really focus opportunity cost with. So if 10,000 defective units are reworked, they can bring in $2,000, 10,000 times 20 cents. But if we scrap them, we get $4 grand, basically double our money. Thus, management will scrap it. And again, if we did not include opportunity cost of them replacing what a new unit would have been, because we can probably sell a new unit more than we can sell a defective unit, we would have incorrectly assumed that would be more beneficial to rework. Because again, that's $1.50 subtracted by 80 cents, that's 70 cents right there. So 70 cents is greater than the scrap. We would have thought, hey, let's rework it. Then we realized we lost 50 cents because we did that, and nobody factored it in. So you have to factor in that opportunity cost. So, scenario number 4. Yes, we're getting close. Okay, so sell or process further. This is now where we're starting to make units. We probably purchased a company, or we decide to wind down the division. Something could have happened, and we have partially completed units. And we could either sell them as is, or actually fully produce them and make them actual products. So usually the book likes this example, and this is a good example. I would even say this, even though the book is saying good example, is peanuts. We sell them as is. We can include them as part of other products like 12 mix, or we can process down further, make peanut butter. Peanut butter, yeah. So peanuts are like a good one to sell and process further. But again, we're going to show fast track. So fast track is assuming there are 40,000 partial completed units of product Q. Secret product. Product Q. Makes a strange Powerpuff Girl. Forgot to use Chemical X. But to make these units, Professor Utonium has already incurred $30,000 of manufacturing cost. And he's got a few alternatives. He has Professor over here goes, let's sell the 40,000 partial completed units to another manufacturer for 50,000. While Professor B goes, life is like a box of chocolates, but let's go ahead and process this product a little bit further into 3 finished products, X, Y, and Z, and later we'll call them Bubbles, Blossom, and Buttercup. But if we do this, this will cost us an additional $80,000 and will result in revenues of $150,000. Okay, so we have Professor A and Professor B, our 2 scenarios, and the question is to Professor Utonium: should the product Q be sold as is, or should we process further? So let's break it down. Breaking it down. And here we go. So it's like, oh my god, it sounds so hard. But really, all we do is compare. If we sell product Q, the additional revenue we get is 50,000. But if we process further, the additional revenue we'll get is 150, even though we incur cost of 80,000. So additional cost of 80, 150,000 minus 80,000 is 70,000. So 70,000 is greater than 50,000, which means, Professor B was always right, and it is more beneficial to process further than selling as is. So now we have the Powerpuff Girls. So we should sell as is. It's better. And we go to scenario number 5. So scenario number 5 is usually the toughest of them all. It has a little bit more. And this is where we get all Thanos on our company and decide if we should eliminate something. So right now, Fast Track is considering eliminating its treadmill division, which reported a $500 operating loss for the year. Oh wow, only 500. But Fast Track, man, they make cost of $1 so of stuff. Sell product for $10. So 500 may be actually a lot to them. So of course, just in prior chapters, we bring in the income statement for our division. And of course, it's got sales, cost of goods sold, gross profit. It has our direct expenses, the departmental contribution to overhead, and then it has indirect expenses. And from there, that's where they get the $500 loss. So we gotta look at this and we'll go look at the big picture. We're going to have to separate out stuff. And this is going to be separating out in two different things. And that, again, let me zoom in so you can see. A bit too close. So, we classify all costs as either avoidable or unavoidable. Just like the iceberg that hit the Titanic. Was it avoidable or unavoidable? That'll make you think. You would think a big old ship should avoid it, but somehow it feels like it was destiny. Or we wouldn't have a good James Cameron film. Well, Jack, don't go. So, avoidable costs. These costs are those that are specifically part of the segment and would not transfer if we eliminate it. Basically, yeah, Thanos snap, it's gone. It's not transferring to anything. On the other hand, you have unavoidable costs. These costs, no matter what, they're not directly tied and they will stay with us. In fact, they will go to another segment and eat on that like a virus. Yum, 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 yum. Yum, 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 yum. Anyway, so what we're going to look at is what the costs are. Now, it may be good, maybe bad. We're going to see usually management helps us out on this one, or just us analysis and seeing what will end up going because we've already basically allocated what we could. So the question here, this is our scenarios. If revenue is greater than avoidable expenses, we do not eliminate. It stays. If revenue somehow is less than avoidable expenses, we must eliminate, must get rid of. So, how do we see this? Well, we get a nice little chart. And again, it's going to be performed mostly putting two sides together. So, here's our total. This was from our income statement. From here, avoidable expenses, if we decide to get rid of it, will be cost of goods sold. Cost of goods sold is directly tied, it'll go away. Same thing with any employees. Well, we're getting rid of them. It's kind of like any business that goes down. They're closing up shops. They're trying to get rid of the workforce. They don't need it. But depreciation, since that's equipment, and most likely we're keeping the equipment for something, that depreciation will be unavoidable. It's going somewhere else. So that goes in our other column. Here, indirect expenses. Well, rent and utilities expense will always happen. Those are like true fixed costs. That's the factory overall. So of course that's unavoidable. But advertising expense. Advertising could change. If the company's gone, well, that division, they no longer need to advertise. Thus, we avoid it. Insurance also can go away. But notice this. Insurance has avoidable costs. Some will go away if the division is gone. But some will remain. It's insurance. It's not always going to go away. Next is office department expenses. It's their share. Again, that's an allocated little item. So some will go away, some will not. Some are unavoidable. And also, purchasing department expenses. Again, some will go, some will stay. In fact, a big old chunk will stay. Yee! So when we do this, add up all your expenses. So our total avoidable expenses is $41,800. Unavoidable is only $6,500. But the sales is still greater than the avoidable expenses. Thus, state basically we keep. Okay. So again, here's our notes. Avoidable expenses would be eliminated with the segment, and more appropriately, they're relevant costs to consider. Unavoidable is irrelevant because they're not directly tied and they're going to stay forever anyway. For expenses such as insurance and department costs, they have both avoidable and unavoidable. Thus, would be allocations that made to the treadmill division use allocated methods that we've already done in chapter 22, prior chapter, and only the portion that was not directly tied to the treadmill division would be unavoidable, and again, irrelevant. So, again, conclusion, we should not eliminate revenue is greater than avoidable expenses. Yay! Treadmill lives to run another day, dudes. Yeah. So, last scenario, and we're all done for this train ride to Infinity War. So, scenario number 6, keep or replace equipment. Just kind of like they made the decision to keep or replace vision. Too soon? Nah. Anyway, so typical rule, we should replace if reduction in variable manufacturing costs from new equipment is greater than net purchase price of new equipment. We do not replace if reduction in variable manufacturing costs from new equipment is less than the net purchase price of new equipment. So, net purchase price of new equipment, again, will equal cost minus trade-in allowance minus cash receipt for old equipment, or better known as the boot, das Boot. When we always trade in stuff and you do that kind of stuff, cash tends to be called the boot. It's like a little extra thing. So if you put a snake in the bag, well, there's a snake in the boot. Sorry, that was bad. Anyway, so fast track. Again, they have a piece of manufacturing equipment with a book value of $20,000. And in case you need to remember book value, that's cost minus accumulated depreciation. And that comes straight from those good old 2301 days in financial accounting. Hey, even smiley face. Smiley! So, the remaining useful life of the equipment is 4 years. And we'll have a salvage value at the end of 4 years of a goose egg. Flat out 0. The current market value for the equipment is $25,000. Yay! So a new piece of equipment comes along. And we're going to look at purchasing it at a cost of $100,000, and we'll receive $25,000 back from trading in the old equipment. The new equipment will have a useful life of 4 years as well, and will reduce the variable manufacturing costs by $18,000 per year. Okay, so here comes the question. Should we keep or should we purchase? Well, here's our analysis. Alright, so if we increase or decrease, the cost to buy the new machine is $100,000. Yay! The cash received to trade in the old machine was $25,000, and because cost, money's going out, $100,000 right there, we have to basically get into a positive. So cash received from the old machine, 25, reduces it because now it's only like $75,000 to buy the machine. But the reduction in variable manufacturing cost is only $72,000, or about $18,000 per year times 4 equals our $72,000. Well, this gives us a decrease in net income of $3,000. So overall, the picture is we lost $3,000 purchasing it. So with that, the book value of the old equipment, $20,000, is known as a sunk cost. We don't care. It is what it is. It's the book value. What we do care is if this becomes positive or negative if we buy it. So, since it's negative, basically means even after everything, we still went $3,000 over budget. The company should not purchase this new equipment, and should keep the old one because the old one's doing a better benefit. Yay! So the train is gone. Head off to the last and final destination of the lecture videos. So here it comes. So your conductor, Professor Narragon, has to hitch the ride and head off to that next good old video. So all aboard with me with that, and I will see y'all at the next stop.